Let me ask you something uncomfortable. What if the financial crisis everyone thinks is coming has already started? And what if the people yelling everything is fine are the exact same type of institutions that said the same thing in 1929, right before the world watched the markets fall 89%? What if the warning signs were not only visible, but identical? Because here's the secret. For the first time since the Great Depression, Wall Street is flashing the same red warning lights: liquidity shortages, leverage loops, synthetic assets, and a silent credit freeze forming right under the surface. But you won't hear this on the news. You won't hear this from banks. And you definitely won't hear this from the people who built the system that's now cracking open. So here, ask the question. Why does 2025 look so much like 1929 that even insiders are panicking behind closed doors? Before we dive in, where are you watching from? I want to see how far this community reaches, because the more people who wake up to this, the harder it is for the truth to stay buried. And if you want the unfiltered, non-corporate, non-sanitized breakdown of how money really works, tap that subscribe button. This channel exposes what they don't want discussed publicly. Now, let's go back not to 2024, not to 2008, but to 1929, the moment the world changed forever. And let's see why Wall Street historians are saying the quiet part out loud. We've even here before. To understand why 2025 looks like a mirror image of 1929, we have to stop looking at the event's stock prices, interest rates, inflation, and instead look at the mechanics. Because history doesn't repeat through headlines, it repeats through systems. In the 1920s, the US economy was booming. Consumption up, credit flowing, markets euphoric. Banks were lending money they didn't actually have. Sound familiar? People believed the new system was invincible. Margin loans, corporate credit, synthetic financial products, the illusion that everyone could be rich. Sound familiar? Then came the real problem, one the public never understood. The financial system had quietly created $30 of credit for every $1 of real money. That wasn't innovation. That was a bomb. And when one bank tightened lending, when one firm got nervous, when one group started to pull liquidity out of the system, the entire credit machine froze. Stocks didn't fall because people panicked. They fell because the fuel behind the market fake credit expansion disappeared overnight. Sound familiar? Now fast forward. We tell ourselves it can't happen again. We have regulations. We have central banks. We have circuit breakers. But here's the truth nobody wants to say. Regulations fixed the old problem. They didn't fix the new one. In 1929, the collapse came from banks. Today, it comes from something far more dangerous: shadow banks. Unregulated, unsupervised, unseen, and the amount of synthetic liquidity they've pumped into the system. Not 30 to 1, not 50 to 1. Try 180 to 1. That's not a bubble. That's nuclear finance. Look around. Asset prices inflated beyond logic. Corporate debt at $12.5 trillion, the highest in history. Consumer debt above $17 trillion, the highest ever recorded. US banks holding less than half the liquidity needed if credit freezes. And what's the response from the media? Everything is fine. 2025 is stable. No need to panic. Sound familiar? Because that's exactly what newspapers said in October 1929, the very week before the crash. And here's the detail almost nobody knows. The warnings in 1929 didn't come from the public markets. They came from internal liquidity metrics on Wall Street. Those same metrics today, they're breaking. And the people who understand what this means, they're already repositioning their portfolios. They're already reducing risk. They're already preparing for a liquidity winter. Why? Because the system we have today isn't built on cash or savings or productivity. It's built on the shadow banking liquidity pyramid, the most dangerous financial structure ever created. And it looks exactly like the credit pyramid of 1929, just bigger, faster, and far more fragile. But before I show you how it works and why it collapses faster than anyone expects, you need to understand the person, the decision, and the moment that created it. And trust me, sound familiar? Now we enter the twist. Here's the part almost nobody knows. The modern financial system didn't evolve naturally. It was engineered deliberately by one critical decision on Wall Street in the late 1980s. Not by Congress, not by the Federal Reserve, not even by the president. It came from a group of financial architects who discovered something dangerous. You could create money without actually having money, as long as you did it outside the banking system. This was the birth of the modern shadow banking system: money market funds, broker-dealers, hedge funds, structured credit firms, and repo lenders. And they found a loophole. If banks create money through lending, shadow banks create money through collateral multiplications, the ability to lend the same piece of collateral 20, 40, even 60 times. No regulation, no transparency, no capital requirements. This was the moment the real modern economy began. Not in the 90s tech boom, not in the 2008 housing bubble. It began when Wall Street realized we don't need cash, we can manufacture liquidity. And once the door opened, everything changed. Derivatives exploded, repo markets exploded, off-balance sheet lending exploded. Even the Federal Reserve admitted years later, we do not have visibility into shadow banking exposures. Translation: we have no idea how much invisible money exists. This wasn't an accident, it was a design. While the public was focused on stocks, bonds, and real estate, the real game was happening in the shadows. This new system was created to bypass the old rules, to generate limitless credit without any of the old constraints. And for a while, it worked. It fueled booms, it inflated assets, and it made a select few incredibly wealthy. But it also built a system so interconnected and so dependent on this manufactured liquidity that the slightest tremor could bring the whole thing down. Think of it like this. The traditional banking system is like a well-regulated dam. It holds back water, releasing it in controlled amounts. The shadow banking system is like building 100 uninspected, unregulated dams upstream, all feeding into the same river. As long as water flows, everything seems fine. But if one of those dams breaks, the chain reaction is catastrophic, and it's a flood that the original dam was never designed to handle. That's where we are today. The tremors have already started. We saw it in 2008 when the shadow banking system first cracked. We saw it in March 2020 when the repo market froze. We saw it with the collapse of major hedge funds. Each time, central banks rushed in with trillions of dollars to patch the leaks, but they never fixed the fundamental problem. They just added more water to the system, making the next flood even bigger. And this brings us back to 1929. The parallel is unjust the euphoric market or the mountains of debt. It's the hidden fragility. It's the widespread belief that the system is safe because the old dangers have been regulated away, while completely ignoring the new, much larger dangers that have grown in the shadows. The architects of this system sold us a story of innovation and efficiency. What they really built was a time bomb. And the clock is ticking. We have no idea how much invisible money exists in the world, but someone did. And here's the twist. This entire system, this house of cards, can be traced back to a single architect, a name almost never mentioned publicly. A person whose decisions shaped every major crash of the modern era. 1987, 1998, 2008, and now, it seems, 2025. And if you think this name belongs to a politician or a central banker, you won't believe the truth. The receipt is wilder than you think. Because once you see who built this liquidity pyramid, you'll understand why the warning signs today are flashing brighter than they did in 1929. Now, let's open the machine and see how this pyramid really works. Welcome to the core of the video. The part they never explain on mainstream TV. Because if the public truly understood this, confidence in the entire system would evaporate overnight. Let us break down the shadow banking liquidity pyramid in a way you've never heard before. The core idea is simple. Shadow banks create liquidity faster than central banks can track it. And they destroy that liquidity faster than central banks can replace it. This is why the crashes of 1998, 2008, 2020, and now the looming threat of 2025 all share the same pattern. First, rapid synthetic liquidity creation. Second, a hidden leverage explosion. Third, a sudden liquidity vacuum. And fourth, a market collapse before anyone can intervene. This is not an accident. It's an engineered structure. Let's start with the foundation. The 4 levels of the liquidity pyramid. At the very bottom, the smallest layer is real money. This is actual cash, deposits, savings, central bank reserves. In 2025, this number is shockingly low. Only about $4 trillion truly exists as liquid cash in the entire US system. Everything above this, it's not real. Now we enter the next level, collateral money, the hidden expansion. This is where shadow banking begins. Here's the trick. If you own a US Treasury bond, you can use it as collateral to borrow cash. But the problem is reuse. That same bond can be lent to someone else, who can then lend it to another and another. This process is called rehypothecation. So, a single $1 billion Treasury bond can be used to create $40 billion of liquidity. That's a multiplier of 40 times. This is how the pyramid grows, and the collapse begins when this multiplier breaks. The next level up is synthetic liquidity, the mirage of stability. This is where the danger becomes explosive. We're talking about derivatives, futures, options, interest rate swaps, credit default swaps. Wall Street discovered they could create artificial liquidity, backed not by cash, not by collateral, but by complex mathematical models. Models that assume stability. Models that assume volatility will stay low. Models that are often wrong. The total derivative exposure in the US today is around $220 trillion. Compare that to the $4 trillion in actual cash. That's 55 times more synthetic money than real money. Now ask yourself, what happens when all that synthetic liquidity needs to be converted back into real liquidity? The answer is simple. It can't. That's when the system freezes. This brings us to the top of the pyramid, the liquidity mirror. This is the part you feel directly. Stock prices, bond prices, housing prices, crypto prices. All of these values are simply reflections of the liquidity underneath them. If liquidity rises, prices rise. If liquidity drops, prices collapse. So, what happens when the shadow banking liquidity pyramid unwinds? You get a 1929-style liquidation cascade. And that's exactly what the data for 2025 is beginning to show. Here are the 5 shocking numbers that Wall Street insiders are staring at, proving the parallel. Number 1. A repo market liquidity shortage of over $620 billion. This is the exact same liquidity shortage pattern that appeared right before 1929. Number 2. A synthetic leverage ratio of 180 to 1. This means for every $1 of real money in the system, there are $180 of claims on it. Number 3. Corporate default risk is up 266% since 2022. Corporate debt is the new margin debt of 1929. Number 4. The silent withdrawal. Over $1.2 trillion have been quietly pulled from banks. This is the modern version of a bank run. It's digital, it's quiet, and it's much, much faster. And number 5. Interbank lending is freezing up with a 12% decline in just the first quarter of 2025. In 1929, the crisis started when banks stopped trusting each other. Sound familiar? So what's the modern trigger? Why is 2025 the breaking point? In 1929, The trigger was margin debt. In 2008, it was mortgage derivatives. In 2020, pandemic liquidity shocks. In 2025, it's the repo collateral inversion, the moment the system demands more collateral than actually exists. Remember, the entire liquidity pyramid depends on that reuse of collateral, on rehypothecation. If one level stops accepting collateral, if one lender demands cash instead of collateral, if one synthetic product breaks its model, you get a chain reaction. And that chain reaction is already happening. Bond volatility is hitting 2008 levels. Hedge funds are reducing their leverage by 30%. Derivative spreads are blowing out. Repo rates are spiking. Corporate bond buyers are refusing bids. U.S. Treasury liquidity broke multiple times in 2024 and 2025. All of these are identical to the pre-crisis signatures of 1929. The difference? The system is now global. The leverage is now hidden. The synthetic liquidity is now deeper. And the unwind is faster. What took weeks in 1929? What took months in 2008 can now happen in hours. That's the real danger of 2025. So here's the final warning. The system today is not stronger than it was in 1929. It's more fragile, more interconnected, and more dependent on invisible liquidity that no central bank controls. In 1929, the crisis started with margin debt. In 2025, it starts with synthetic credit liquidity that never really existed. Backing valuations that can't be defended inside a system built on borrowed time. This is not fear-mongering. This is structural reality. Every crash in modern history has one root cause. The illusion of liquidity is suddenly replaced by the demand for real money. And in a world with $4 trillion of real liquidity against $220 trillion in synthetic exposure, the math writes the ending for us. You can't print collateral. You can't legislate trust. You can't regulate panic. You can't stabilize a pyramid when the bottom disappears. And that brings us here to the unavoidable conclusion. 2025 doesn't look like 1929 by coincidence. It looks like 1929 because it's built on the same hidden structure, just larger, faster, and engineered by people who assumed they'd never get caught. So ask yourself, are we wiser now, or are we just walking the same path in better suits? Comment your country below. I want to see where the awake minds are watching from. And if you want the truth unfiltered, unedited, and unapproved by anyone with a stake in the lie, hit subscribe, because this story is just beginning.